presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Market Update for June the 13th, 2023. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Let's start with the market. NASDAQ the S&P has entered a bull market since the 2022 low, which we were down to 3481 or so, 3,500 plus or minus, and everybody said, oh, that's the end of the world. It's going to 2,000, it's going to 2,200, it's going to 2,800. Everybody had all these numbers. You heard me say in October, I said, this is a fifth wave bottom. Looks like a bottom to me, and from here, I didn't know if that was a bottom, but looking at that in hindsight, within a couple of weeks, it was looking like a bottom. You can look at property prices. They've come down more than 15% over the last 12 months. This is the commercial property index, and you can see that it has rolled over and it is in the negative. So it has come down a bit. I think it'll continue to put pressure on that. But as property prices, commercial property prices come down, real estate prices as a whole is coming down. When real estate comes down, that is rents come down. Well, we think rents, which I talked about last July when inflation hit 9.1%. You heard me say on this broadcast, I think we've reached a peak. And I showed you why. What were the things that were contributing to inflation? We thought inflation would be coming down. Well, today we got an inflation number. It's at 4%. It's down from 4.9 to 4% on a year-over-year basis. So we have cut inflation more in half. You heard all the gloomers and doomers out there that said, oh my God, the world is ending. No one was able to buy gasoline or food. They'll have a choice. Gas is so high, food is so high, all of that. Then everybody was talking about, just a couple of weeks ago, the debt ceiling. Oh my God, that's going to cause a crash in the market. Now we're hearing about everybody. Now it's something or the other all the time. Now everybody's starting to get a little bit too happy. They don't have anything to worry about as far as the market is concerned. That starts to worry me, and I'll tell you why. We've come up from 3,500 to 4,400 nearly, so we've gone up at nearly 900 points in the S&P. That's a big move from the October low to where we are right now. We've seen all the money that was out there. That was 2.15 trillion. That was the amount that was sitting in people's bank accounts because they were unable to spend because of the pandemic. Well, most of that is down. We still have about 900 billion sitting out there, so we still have quite a bit of money, but from we've spent nearly 1.2 trillion. So let's start with the Fed. If you look at the core inflation versus Fed policy, typically the CPI well below the Fed fund rate before pauses or cuts occur. So if you're looking at the Fed fund rate, which is CPI is at 4%. Fed fund rate is at 5%. That's when the Fed usually stops raising interest rates. As I said a couple of weeks ago, I thought the Fed was going to pause or skip, and that's what they've done. But now they're talking about raising interest rates again 2 more times, and that was a change in the dot plot, which was a little bit of a surprise to the market, that they are going to raise interest rates 2 more times, once in July and once in September. I don't know if they're going to do that or need to do that. That is the question. Is it they need to keep slow down the economy? Why? Do they want unemployment to go up? Yes, they want to slow down the economy, slow down inflation, but inflation is down to 4%. They want it down to 2%. That's the mantra, and you've heard me talk about this for the last couple of years, that I believe the Fed will let inflation run hotter, even though they'll keep on talking about 2%. But if it's at 3, 3.25, 3.5, they'll say, we can live with this inflation. We are fine. We do not need to kill the economy. That's a decision the Fed will have to make. I think over the next 3 or 4 weeks, we're going to see a lot of hoopla, just like we heard about the war that was going to kill the economy. Then we heard about the inflation was going to kill the economy. Then we heard about something else that was we saw the recession for the last year and a half that everybody's going to, as we're looking for, is going to kill the economy. The debt ceiling problem was going to kill the economy, and the stock market. Well, the stock market just hit 4,400. It just continues to go high. I believe it's stretched, and we'll take a look at the technicals in a little bit. But again, the next mantra over the next 3 or 4 weeks will be, oh my God, the Fed's going to raise interest rates in the July meeting, and that's going to put us in a recession. We need to slow down. The demand is still there. And as you've heard me talk about on the daily radio broadcast that I do every day for the last couple of years, as long as the unemployment is low, bringing demand down is going to be difficult because people are still continuing to spend. And as long as they have a job, they can put it on the credit cards, they'll continue to spend. And that's what we are seeing across the board right now. We had the Humphrey Hawkins testimony, as it's called. Twice yearly, the Fed chairman of the Federal Reserve comes in front of Congress and lets them know what they're thinking, what they might be doing. What he basically said is that they are going to raise interest rates 2 more times. The probability is they're going to raise rates in July by 25 basis points. And that's about a 75% probability in the futures market on the Chicago Mercantile Exchange. That's what it's predicting. Now, those change every single day, those odds, and they can change dramatically. I'll talk about that in a second. Also, there's a 25% chance that they're going to raise interest rates in September again by 25 basis points. I think inflation is coming down. We are going to get an inflation number, the CPI number, before the July meeting of the Fed Open Market Committee. And if that number is down like it was from 4.9 to 4% for inflation last month, if it comes down somewhere in the low threes, I think it might give, again, the Fed some room to pause. We are starting to see some unemployment starting to go up. The claims for unemployment hit a 21-month high. That's what we're seeing. The claims are starting to go up. More people are asking for unemployment. That means the labor market is starting to loosen up also. And if unemployment starts to go up, there'll be a lot of pressure on the Fed to stop raising interest rates. The Fed does this. They go overboard. They went overboard by keeping rates too low, too long. Now they might go too high, too quickly. That's what might happen, and they might break something in the process. The Fed does not want to do that. To engineer a soft landing, I think they're going to be hawkish. You've heard me talk about that in the broadcast, where they say they're going to be not hawkish, that's when they raise rates, not dovish when they lower rates, but talkish, where they're going to talk a tough game and say we want inflation at 2%. But inflation running at 3%, they might just tolerate it and continue to say, just like they did with unemployment. If you remember Bernanke, a few years ago, he said, unemployment goes below 6%, I have to raise rates. We're at a 50-year low. Nobody talks about unemployment being too low. And that is the same thing, I think, with inflation being 3.5%. The Fed will let it go. That's my thinking. Looking at the markets, technology has done incredibly well this year. It is up about 40%. Everybody now. What happened to crypto? Everybody forgot about crypto. Now it's AI. That's the big thing that everybody is chasing. Let me buy some AI, I'm going to get rich. Having a diversified, balanced portfolio with the right goals. That's what you have to get done first. A year over year, core inflation is still going up. We have to have that coming down. We get the PCE, as it's called. That's the Personal Consumption Expenditures Index. I know it's a mouthful, but that's what the Fed looks like. It's a core. That's what they look at. That if that starts to come down, the latest number is 4.3. We get another number on Friday. If it's below 4, that would be good. Those are my thoughts. Those are my views. Have a wonderful week, and I will see you in the next few weeks.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.